Hi, my name's Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this week's supply and demand, Forex, gold, and S&P fundamental and technical analysis for the week ahead, starting the 17th of November. Hope you all had a great trading week, and let's get into the week ahead news. So, it will be a relatively quiet week in the US with the spotlight on manufacturing and services PMI data along with housing market updates such as building permits, housing starts, and existing home sales. On the monetary policy front, speeches by Federal Reserve officials and ECB President Christine Lagarde will draw attention, as will interest rate decisions from China and RBA meeting minutes. Inflation figures will be key in Canada and UK and Japan, while Germany will release producer price data. Flash November PMI readings are expected from Australia, Japan, Germany, the Euro area, and the UK. Meanwhile, balance of trade figures will be released for the Euro area, Switzerland, and Japan. Retail sales data will be highlighted in Canada and the UK alongside UK's GfK Consumer Confidence Index. So it looks like the US data might be taking a bit of a back seat, and the focus is more, on Canada, the UK, Europe, and Japan. Yeah, let's get into the technicals and some more fundamentals. So starting off on the US dollar, and actually, in fact, before we get into the US dollar analysis, I did receive a question from Davan Igris on YouTube, and I thought it was a really good question, and it's I'm going to answer it. Well, the answer is going to be at the end of the analysis, so stick around if you want to know the answer to this good question. And he says, great analysis as always, Leon. A question though: when it comes to buying the rumor and selling the news in order to take advantage of rates expectations, should we take risk sentiment into account or follow the big players chasing yields? With respect to weak economies such as New Zealand, Canada, and Europe, who are cutting rates more and faster than the rest, would pairing them against the Japanese yen, who may be on a hiking cycle, albeit slowly, make sense? Or because we are more risk on, even though the New Zealand dollar, Canadian dollar, and Europe may be cutting, they still have better yields. Thus, risk sentiment plus higher yields for longer may cause some appreciation. And it's a very good um, question. It's something that I actually answered in the private members group, but I'll give the answer and I'll explain my thoughts on this question at the end of the video. So, getting back into the dollar index, and the dollar index, equally weighted dollar index, is just a measure of dollar strength against various other currencies that we trade, and there's a link in the top right hand side if you want to apply the equally weighted dollar index to your trading view charts and the calculations. So overall, fundamentally, I do think that the dollar is a buy. Basically, what's happening is that Donald Trump's election has caused the market to kind of rethink where the economy is going, and Donald Trump's policies are seen as actually inflationary, which and also they made Donald Trump's policies may actually cause the US to avoid a recession, or at least prolong the recession for now, because recessions are inevitable. That's the economic cycle. But the outlook is a lot more positive for the economy, and therefore inflation. And if inflation starts to come back into the US economy, then there's less need for rate cuts. And so, with interest rate cuts being priced out, is the reason why you're seeing the dollar actually start to rally as the market starts to price out those rate cuts. Now, technically, of course, you really want to just be a buyer on a bit of a pullback, right? If you can get one. But also something to be mindful of is that the dollar has strengthened quite sharply. So this chart basically shows basically the deviation and the mean, and so we are really above these deviations. So two standard deviations. So it doesn't happen often. You know, this is the last 10 years since 2014 and 10-year average. And, you know, there's been periods, of course, where we've, you know, extended above those two standard deviations. And we've basically come back inside. You know, the market will always, you know, revert to the mean eventually. Yes, it could take, you know, weeks, months, and sometimes even years. But ultimately, if we're above the standard deviations we've seen historically, what typically tends to happen, traders will end up taking profit. Traders want to buy for cheaper as well. So although yes, I am a buyer of the US dollar overall, I actually do think that there could be a bit of an opportunity to potentially short the dollar. So path of least resistance is still to the upside, but ultimately we are very extended when it comes to, you know, the move from, you know, this low to this high. We haven't even really had any kind of major pullback. So um make of that what you will. If you are looking to short the dollar, then it is something that, you know, you have to be mindful that there could still continue to be dollar strength. But as we get closer into really the rate cutting cycle, and inflation data did come out last week, and it was talking about, you know, treasuries rallied as traders added to wages that the Federal Reserve will cut rates by another quarter point next month in line with inflation data. So inflation data showed that they are going to cut in December, or the likelihood is that they're going to cut in December. And so the market was kind of getting ahead of itself, and there was a possibility that they may not cut in December. And so, you know, there's basically, you know, the data has kind of shown that they're likely to start cutting in December. So the upside potential for the dollar could be, you know, this week or into the next coming weeks. So let's see what happens there. I am bullish on the dollar on pullbacks, but if you are looking for a counter fundamental move, counter trend move, then I think the area, there's lots of evidence supporting why you should, or you could, I should say, not should, but could get involved in the dollar in a dollar short. So it said here swaps traders boosted about 75% the probability that the Fed will cut rates again on December the 18th, up from around 56% earlier Wednesday. Through June, they priced in nearly 60 basis points of cumulative reductions. So, you know, cuts are being now priced back into the market, and that could. You know, weaken the dollar over the next week or two or three. So, or into at least the meeting. So there's the dollar index. Looking at the dollar yen, and dollar yen's quite interesting. Again, with the potential for dollar weakening, we could see, you know, prices pull back. But also as well, the yen is the one of the only central banks that are looking to hike rates, and there is some kind of news that the Bank of Japan may actually start to either intervene and try to stop their currency from weakening too much. And so they may also look to hike rates a bit sooner. So it says here the yen weakened beyond 155 per dollar for the first time since July, raising the risk that Japan may enter the currency market yet to try to slow the depreciation. So the Bank of Japan really don't want a weaker currency, because a weaker currency pretty much means contributes to inflation, and they're trying to get inflation down to their 2% target. So the higher or the weaker prices get for the yen, the more that inflation is likely to rise, and therefore they're going to try to enter into the market to stop its devaluation. It says here the drop has taken the yen near levels where Japanese authorities last intervened to prop up its currency, with the nation's top foreign exchange official warning about the one-sided sudden moves. And that's another factor to price in, is that if the moves are quite sudden, quite sharp, in terms of devaluation, then that increases the chances of the Bank of Japan intervening to stop that sharp depreciation. The minimum forecast for the yen that may trigger intervention was 150 against the dollar, with the median at 160, according to a survey of 53 economists carried out by Bloomberg last month. And so, we see here it says Japan tries to limit weakness in the yen, and this is, I guess, the historical um, chart of when the yen and the Bank of Japan was intervening, and so they did it twice in 2022. Eventually, they did stem the weakness and caused the yen to appreciate, and then, well, in 2023 and once in 2024, where we've had again some more intervention in the market. Then we had it again in early 2024, where they're really trying to stop the weakness and the depreciation and devaluation of the yen. And so they say that 160 is the median. So if we do, the more we kind of get up to these areas, we could get more of a sharper pullback. But I do think ultimately the dollar yen is a buy. So any pullbacks down into the 153s, 152 areas, I think is going to be quite nice for a buy trade. And let's see what happens there. But again, I'll get into a bit more detail about my thoughts on buying the yen. I think you can look for buys and sells on the yen. But again, towards at the end of the video, I'll go over my thoughts on the question, which was asking about buying the yen or selling the yen in terms of hiking rates and others cutting rates. And so, yeah, I think the path of least resistance is still to the upside. But if we get some dollar weakness down into these zones here, maybe even down into this area here, I think that could be quite nice for buy trades. Dollar Swiss again, really just looking for buy trades. On the dollar Swiss, the Swiss franc and the Swiss National Bank are looking to cut rates next at their next meeting and into next year. So really, a pullback into that zone should be really the best opportunity. Of course, if you are looking to short the dollar based on profit taking potentially, and the fact that it is very expensive, of course, this is going to be a very nice level to look for a short trade. Same thing with the dollar CAD. Dollar CAD should really be a buy. Really no levels. Hasn't been that high for a while. I think the last time it was up here was May 2020. So I would say if you are looking to short the dollar on this one, you'd have to really kind of wait for proof that there is at least some supply coming into the market, then a pullback up into that zone before looking for a long trade. Sorry, a short trade. But again, I think the path of least resistance is to the upside. So for me, I'd be looking for prefer anyway at least a decent pullback down into this area here before looking at going long on the Canadian dollar. The Bank of Canada are looking to cut rates quite, I won't say aggressively, but definitely more at the moment than the Federal Reserve. So as long as that continues to be the narrative, then really this trend should continue. The pound dollar. So the pound had some GDP news this week or last week, and it wasn't great. It definitely wasn't great. The economy kind of slowed a bit, but the the focus of the central bank was is inflation. And so whenever trading news, one of the questions to kind of ask is, does the news data and the data released, does it really change the central bank's thinking when it comes to their path of whether they're looking to hold rates or cut rates or hike rates? And so, before the news, of course, the data was that if, the GDP comes in worse than expected, is it possible that the Bank of England will start to cut in December? But the data didn't really prove that. It didn't convince the market of that. So and also as well, the Bank of England have been saying repeatedly that they are really more focused on services inflation as their measure as to whether they want to cut rates in December or not. So it says here services inflation is more important for the Bank of England. So instead, officials are laser focused on services inflation, the next batch of which is due next week. So progress has been improving here, though we agree with the Bank of England that it is likely to stick in the 5% area for the next few months before turning lower again from the spring. So, barring any downside surprises, we think the next move in December is a pause before another rate cut in February. So, as long as inflation remains sticky, and doesn't necessarily come down, it won't convince the Bank of England to cut rates in December. Therefore, when you're looking at a price chart, not necessarily against the dollar, um, but against maybe some other currencies, the pound, in my opinion, really should be a buy. And like I said, it's at the moment it doesn't look great, does it? But I do think that we could see actually a bit of a reversal here if you are looking to buy the pound against the dollar. Not really a pair that's on my radar in terms of if I'm looking to buy the pound, it's not really going to be against the dollar. But if you are trading this, we could see obviously the the dollar as being quite expensive, but the pound also, depending on the data that comes out, if services inflation does remain sticky, then we could see a limit to the downside on this. So we could see actually a bit of a reversal here, based on purely on the data. But I'm a bit more bullish on the pound at the moment. So I am looking for buy trades on the pound, but just not against the US dollar at the moment. So but the path of these resistance, I think we should maybe get a bit of a reversal and maybe enter into some sort of range or auction market going into the end of the year. So looking at the pound yen, so the pound obviously selling off a bit. It was due a bit more of a pullback. So again, not really a pair that I'm interested in. But if you are really a pullback down into maybe that within this demand zone, but you also have a level of support and resistance where you can see the market has basically traded that area. The 194 round number I think is decent. If not, then maybe down to the 190 round number before going long. So yeah, that's where you are. In fact, I think there's probably another level just in between here as well that you can look towards. Yeah, I would say that zone there. So the 192 round number as well before looking at going long. If you're looking to buy the pound, of course, if you're looking to sell the pound yen and buy the yen, then a pullback up into this area is decent. Although this area has been touched once already, and the more times it gets touched, is the less of a bargain it is. So, in fact, probably look for maybe some sort of stop hunt above that area if you know how to trade stop hunts before looking for short trades if that is a pair you want to look to trade. Looking at the euro index, and this is again the equally weighted euro index. And so this is just a measure of euro strength against the pound, the yen, the CAD, the Australian dollar, the Swiss franc, the New Zealand dollar. And at the moment, the euro index is down towards these lows. So I'm looking for short trades on the euro at the moment. When we look at the Eurozone fundamentally, it's saying here that bold bets on European central banks' next move on interest rates are making waves in the options markets. So one trader paid 625,000 euros or 661,000 US dollars for options that will pay out tenfold in two scenarios, according to people familiar with the transaction. The first is if the ECB reduces rates by a hefty 75 basis points in December. The second is if the central bank cuts by half a point and indicates another move lower in January. So there is a lot of bearishness coming out for the on the euro, and it says here money markets are already factoring in the chances of a steeper cut from the ECB. The probability of a half point reduction in December has more than doubled since the election results last week to 25%. That's because the comprehensive victory, including the Republican Party taking control of both chambers in the US Congress, makes it more likely that Trump can enact his tariff proposals. And so, you're seeing much larger rate cuts being potentially priced in to the euro. Therefore, you're seeing continued euro weakness, right? So then when we look at the euro dollar, it makes sense why you're seeing, a move like this, because on one hand, you've got the Fed who are, looking at reducing their rates in terms of, the amount of rate cuts. And then you've got the ECB, right? The ECB, where the market is looking to price in more cuts. So that's a big divergence, right? They're looking to cut a lot more, or the market thinks they're going to cut a lot more, and the Fed are cutting a lot less. So that's the reason why you're seeing this massive move. But again, if you're looking for short trades on this, you really have to wait for a pullback up into some sort of supply zone, but also as well doesn't mean that prices can't pull back, of course, and you may within the following weeks, because the euro is on the expensive or the cheap side potentially, and the dollar is on the expensive side. There could be just some profit taking, which causes the market to retrace, and you may be able to get a trade out of this if you want to trade this pair. Personally, again, if I'm looking to short the dollar. Based on profit taking and it being expensive, the euro wouldn't be the currency I would do it against. Although I know there are traders out there that would do that. So, but those are the options really for the week and the upcoming future weeks. Looking at the euro yen and euro yen. Again, I think there should be more of a sell than a buy, and you're seeing that kind of play out with the yen, the Bank of Japan looking to hike rates, and the market pricing in more rate cuts for the euro. I do think that the path of least resistance should be to the downside. So, in fact, that should be really a supply zone. So, if you're looking for a pullback, right, pull back into this zone or any of the higher zones would be more preferable to look for short trades. I do think that the yen is probably a bit more of a buy than the euro at the moment. But if you do want to be a buyer of the euro, there could be some data that comes out that shows that the euro may not cut as aggressively as the market is pricing in. And if that is the case, then the euro is likely to potentially rally. So we could see a bit of a move from this demand zone. Euro pound. I am bearish on this currency. Is in I'm buying the pound over the euro. I do think any pullbacks up into that 83 or 84 round number is going to be a zone that I'm looking to get involved in. If course, so of course, if there is an entry, right, doesn't mean because prices come up here that I'm just automatically going to sell. I definitely have to see some sort of entry, because at the end of the day, it's the market that decides whether this is going to work or not. Sounds obvious, but a lot of traders try to impose their will on the market. But you want to look for clues as prices come around here. And if again prices do react to this area and show some sort of entry, then I will look to get involved anywhere from this area here up to these highs, because I do think that the pound is in a better position than the euro. So yeah, shorts really all the way. If you are looking for a long trade, then a pullback into that zone technically is actually really nice. But again, you'd have to really find reasons fundamentally to want to be a buyer of the euro over the UK. Aussie dollar now. If I am looking to short the dollar, the US dollar, that is, it would be against the Australian dollars. So the Australian dollar could be seen as actually quite cheap here, and so if you are looking to short the US dollar, then the Australian dollar is probably one of the best candidates, I think, to look for a buy trade. Um, Reason being is because the RBA are not likely to cut this year, so they're all going to be on hold as well, just like the pound. And so, with the Fed cutting rates and with the RBA holding rates, potentially, of course, no one knows for 100%. It's a probabilities game, but how it looks right now is that they're looking to hold rates. I do think that the Australian dollar could strengthen a little bit against the US dollar, at least back up. So there's some potential upside when it comes to uh, buying this currency pair this week. But again, you really, as if you really are bearish on the US dollar. Looking at gold. Gold, pulling back quite dramatically. Gold could again, with dollars kind of selling off, or potentially selling off, we could see a move to the upside. But I think from a macro perspective, the US at the moment and Trump's appointment to the presidency has increased the chance of a better economy, and higher and potentially higher interest rates, or at least less rate cuts. And in that environment, gold may not do so well. I think gold does obviously a lot better in an uncertain environment, some risk off. And if there are some risk off events on the horizon, then of course, then the investors will typically go to a flight to safety, right? But in terms of just how the dollar is doing, it does look like the path of these resistance is going to be to the downside. But if the Fed do start to cut rates, in December, and the market is doing some profit taking on the dollar, then we could get a decent pullback to the upside. So either where we are now, or maybe down into that area there. And just remember that prices do move in cycles. So ultimately there is going to be a pullback, right? So it just depends on how much the pullback is, or how far the pullback is, and whether you can make money on that pullback. And even when you're in that trade, if you're in that trade and there's something fundamentally goes in your favor, in terms of why you should hold the trade, then you just continue to hold the trade to the upside. But yeah, gold at the moment, bit of a tricky one. You'd have to really, I think it's going to be more driven by what the policies of the Fed and risk sentiment at the moment. And the S&P, pulling back. I do think that any pullbacks down into the 572s should be a decent opportunity to look for a buy. And again, with GDP and the economy, the soft landing narrative, the hard landing would be where you have a recession is imminent. And where when you have a soft landing narrative, it's more to do with, okay, there's going to be contraction, but it's not necessarily going to be felt as much, right? And the recession is going to be prolonged. So I do think that there's going to be traders now looking at this area here of support and resistance to get involved in going long. But in my humble opinion, really the area to look for a trade is going to be down in this area here, because when you think about it from a logical perspective, this is the area that caused prices, the demand. There was so much demand that this was a previous expensive area. That was a bargain area, so much so that prices made new highs, right? So that was, it blew past a previous expensive area. So when we look at, this high now, this is going to be considered expensive, right? Oh, sorry, this is considered expensive. This here is considered, cheap, right? Or the bargain or a discount price, right? And so in between an expensive area and a cheap price is known as fair value, right? This is fair value. Now, there's nothing wrong with buying at fair value, but being a fundamental bargain hunter, I want to buy at these lows. So if prices don't come down and they continue to go higher, then fine, it is what it is. But ultimately, I do want to be a buyer down here. That's where I think that the best opportunity is, and so that's where I think traders may, it might seduce traders into going long here and then pull back even more before going higher. So let's see what happens. Who knows? But that's the plan. To buy down here. If I miss this trade and it keeps going higher, then it is what it is. I'll just have to miss out on that opportunity. So that brings us to the end of the analysis. Getting into some of the new trades that I took this week in the trade update, and then getting into the question from YouTube. So looking at the new trades. So this is the the CAD, Aussie CAD. And really, the trade setup was, from a fundamental perspective, was buying the Australian dollar because they're holding rates this year, and the Canadian Bank of Canada are looking to cut rates this year. So ultimately, you want to be a buyer, or I wanted to be a buyer of the Australian dollar over the CAD. And so when prices pulled back into this area, nice demand zone, I went down into a lower time frame, and my entry was here. This is one of my entries. If you've been following me for any length of time, you'll know that I enter into multiple positions and scale in if prices pull back. So what I did was entered here. My stop loss was where it is, and prices then pulled back. Second, prices ended up pulling back and triggered me into three positions. So, well, actually triggered me into two positions. So, got in at the market order, then managed to get in that area there, being a buy order at 90.65. And then when prices pulled back even more, when it spiked down on this candlestick here, I got in on a second position, right? Pending order. My third pending order right there, it didn't get triggered, but my stop losses are all in the same place. So when prices started to then move to the upside, what I'm doing is I'm trying to get myself to a break even position as soon as I can. So that position there ended up being a nice one-to-one trade, and then the second position uh, was a nice here. Yeah, this trade on my broker didn't quite reach a one-to-one, so I'm still in this. Right? I'm still in this trade at the moment, and so yeah, one win, and now I've cancelled the this position as well. So taking the risk out of the market, one win, and then we've got uh, two open positions, and I'm looking to swing trade this up to the upside around here. So I'll take profit on this position here as we reach a one-to-one, and then I'll have just a market order which is around here, and then I'll look to swing trade that up to some daily highs around these highs here, so up to maybe about 3-4 to 1 if it can get up there. The pound CAD took two trades. One was a full stop out on this one, so entered around here, and then prices actually ended up stop hunting quite deeply into the area, um, which is fine. And then I got another position in as prices came up. So again, entered into a market order there, and now prices have pulled back, and I'm in a second position here. So I'm in two positions at the moment. I do expect the pound to rally against the CAD, but of course, the risk to the trade is the upcoming week. Of course, inflation year on year. If inflation, for example, comes in higher, much higher than forecast for the CAD, that could strengthen the Canadian dollar. And then, in fact, if inflation, although it's forecasted at 2.2% year on year, if it comes in less than expected, then of course I'd have to probably just jump out of this trade, because that will cause the pound to probably weaken and the market to price in a bit more rate cuts for the year. So yeah, let's see what happens with that trade. And also as well, trade update, Aussie Swiss. This trade, I was only in one more position. These two positions entered into three positions. Two positions were profitable, and then I was trailing up my stop. Um, trade up my stop to around the 0.5735 area. And so my stop loss was actually right here. And then this week on Wednesday, prices end up pulling back and stopping out my final position. So that was only ended up being like a 0.8 to 1 trade, as I was attempting to swing trade it up to beyond the highs. But sometimes it happens, sometimes it doesn't. But it's still a profitable trade nonetheless. And so now I'm completely out of the Aussie Swiss. And yeah, so those are the trades for this week. Now, getting into the YouTube question. So again, just a quick reminder of what the question was, and they said that Mr. Davan Igris said, when it comes to buying the rumor and selling the news in order to take advantage of rate expectations, should we take risk sentiment into account or follow the big players chasing yields? And uh, you should always take both into account, right? Um, and so, with respect to weak economies such as New Zealand, Canada, and Europe, who are cutting rates more and faster than the rest, would pairing them against the Japanese yen, who may be on a hiking cycle, albeit slowly, make sense? Or because we are more risk on, although the New Zealand dollar, the CAD, and the euro may be cutting, they still have better yields. Thus, risk sentiment plus higher yields for longer may cause some appreciation. And so, the way to look at it, I guess, the way to kind of break it down is like this. And so we typically know that if you've got bank A, right, and you've got bank B, and let's say bank A, it has, let's say, for example, a 5% interest rate. Yeah. And bank B has, let's say, for example, I don't know, 1%. Oh, I'll do it like bank B would represent, for example, the Japanese yen. But just look at it like, this is 0.25%. If you're on the high street, yeah, if you're in, your local high street and you're looking to put your money somewhere for a bigger return, then obviously you're going to go with bank A over bank B, right? You're going to deposit your money. And investors are no different. You want a higher yielding, currency to put your money into. So we know that from a just from a simple economic perspective, right? Now, if Bank A, for example, when it comes to rate cuts, let's say they are expected to cut rates to zero, right? And let's say Bank B are expected to hike rates to, let's say, I don't know, 5%, right? 5%. Then what you want to do, in fact, is you want to buy in terms of currency land. You want to buy uh, currency B and then sell currency A, because rate cuts are actively devaluing, right? Depreciating, devaluing their currency, and so you don't necessarily want to hold that currency, or you're less likely to hold that currency. And Bank B are looking to appreciate, right? They're looking to appreciate the currency because they're looking to hike rates, and they're hiking rates by quite a large amount. Yeah. So they're going down to maybe even 0.25, let's just say, right? Just to make things a bit simple, right? So they're swapping places. over time. So in currency land, that's where you would want to look to buy the currency that is hiking rates and sell the currency that is um, cutting rates, right? So, but where we have the Bank B, which represents the Bank of Japan, the difficulty is that they're not hiking rates by zero, by 5%, right, or up to 5%. They're only really expected to hike rates by maybe something like I think it's maybe up to about 1%. Yeah. So they're only, this is the expectation, somewhere between maybe 0.75 and 1%, right? Now, other central banks aren't going to be cutting rates down to 1%, right? Even when we look at somewhere like a bank like Europe, for example, right? They're looking to cut aggressively, but they may only really cut and devalue their currency and interest rates down to maybe something like 2.5%, something like that. So again, the question becomes: is is the difference between the two enough to cause investors to want to flood into the Bank of Japan at 1%, because they're still obviously still get higher yields at 2.5%, or in, for example, the dollar's case, they're looking to cut rates down to maybe something like only 4%, right, which is a lot higher. Yeah. So there is a situation where you we have to kind of figure out whether the rate hikes are enough to seduce investors into coming out of Bank A, right, which, and Bank A would represent every central bank that is cutting rates, and for them to put their money into Bank B, which would be we represent the yen. And so it's a bit of a tricky one. It's not as straightforward. And sometimes you can have some ideas that are very, very, very straightforward, and some, trade ideas that are not as straightforward. But one thing that I would say is highly probable, because we've got to deal with probabilities here, is that um if you're looking at something like the euro yen, right? Euro yen, we've just gone over the analysis. The rumor is that the euro may cut by 50 basis points, right? And maybe even 75 basis points to some degree, at maybe some sort of outlandish move, right? 75 basis points, 50 basis points. So even if the yen, and even if the Bank of Japan kind of held rates for the rest of the year, the European Central Bank is still devaluing their currency. So just based on that, that's a decent bet that the euro yen should, and again, we have to use these words, I can't say for definite, but it should, right, want to at least devalue. To the how much it will devalue by, who knows, right? And it's the same thing with the Canadian dollar, whether you replace that with the Canadian dollar, CAD yen, or whether you replace that with the New Zealand yen, right? So looking at the currencies and the central banks that are devaluing their currencies, is it enough to convince you and me and maybe the market that that it's going to weaken against the yen? And I would still say yes, right? I would still say yes. Now, there is a currency that I would say is, that the yen should do a lot better than, and that would be, for example, the Swiss franc, because the Swiss franc's interest rate at the moment is 1%. Yeah, so it's actually already quite low, and they are looking to cut by at least I think it's something like maybe 50 to 75 basis points, right? Let's say they cut by 75 basis points over the next few months, right? So if they do cut by 75 bps, right, that would take them down to 0.25, right, percent. Whereas if the Bank of Japan start to appreciate and hike rates from 0.25 to maybe 1% over a period of time, then in fact you'd have the Bank of Japan, you should have a higher interest rate. Now, in anticipation of that happening, the Swiss yen, right, should again is the key word, should really be more of a sell than maybe a currency that has a higher interest rate to start with as they're cutting. Yeah. So, for example, the Canadian dollar, I think, is at maybe something like 4.5%. And even if they go through their cutting cycle and end up at, as I said, maybe something like 2.5%, yeah, um, it's still going to be higher than the yen eventually. So, yes, in the short term, we could get some devaluation, but in terms of the actual the best trade, I think the the central bank that is closer to the yen in terms of interest rates, and where the yen and the Bank of Japan may overtake it in terms of interest rates next year going into 2025, it would be the Swiss franc. So that's the way that I would kind of analyze the question. And again, it's never something that should be set in stone. It's all about probabilities. And if you don't like the trade idea, or if you're unsure about the trade idea, if it's not clear, then the best thing to do is to just look for another trade idea, right? Not all trade ideas are going to play out in the way in your favor, and it's really about looking for the strongest trade ideas. And so for me, that's a good trade idea, right? Because we know overall, the what should happen when a central bank hikes and should happen when a central bank cuts. But then when we get into the details of it, then you start to break down which currency is it: the New Zealand dollar, is it the Canadian dollar, is it the euro, is it the Swiss franc, right? And then you start to then make your choice and your choices as to which one, two, or three, or all of them that you want to trade. And also as well, you may want to manage your risk on certain trade ideas in terms of you may not want to put or trade the New Zealand yen, right, and put the same position size on that you would with for example, the Swiss franc yen, right? Because maybe the Swiss franc yen might be a better trade. You still want to trade both. You might want to trade both, but this one you might want to put. If you got a stronger conviction on that, currency pair, then you put a bit more, or your normal position size, and then maybe you reduce your position size on this one because you think to yourself maybe they've got a higher interest rate, and so although they might weaken their trade, their currency, it might not be to the degree that maybe the Swiss franc, right, and the Swiss National Bank will. So there's ways to manage, the trade. But overall, that would be my answer to your question. I hope it does answer everything. And again, there's no guarantee that the investors will still pile into the yen. Who knows? It has to be attractive enough for the interest rates have to be attractive enough for the for investors to want to get into the yen, or on the other side, the amount of cuts have to be um, less attractive for the investors to then say, you know what, I'm going to take my money out of the those higher yielding currencies. So it's either or in that sense. I hope that makes sense. All right, take care, and until next week, all the best.